if he's with us. Prabhu, can you hear us?
Yes, now I can.
Okay, great.
Are we on the investment section?
Yes, sir. You're up.
Okay, all right. Good morning, trustees. We just have one investment agenda item this morning, and that's the presentation of the fee report for calendar year 2024. But before I get to that, I have some estimates from Makita. Fiscal year-to-date performance for the pension plan as of Tuesday, November 4th. The plan was up 4.79%, and the healthcare trust was up 6.63%. With that, unless there are questions, I'm going to turn this over to Jay, Ron, and Harrison to present the fee report.
We're just going to roll right into the fee report. So I'm just going to have a few words of introduction and context before Ron and Harrison dig into the fees. I look around and see most of the trustees have been on the board for a few years, so I think the phrase should be very familiar when we say this is the most comprehensive fee report in the industry. There's not a lot of similar reports from peers, maybe from larger plans, and I think it's just another example of one of the ways that our staff punches above our weight. That's a pat on the back. So for history, we started this report almost 10 years ago with Dinesh, and then David, and then Harrison, and now Ron. So it's a little bit of a rite of passage. Ron's been working on this report for about 6 months now. A lot of data collection and organization, so a lot of spreadsheet entering. Clearly lots of time and effort. So the question is, why do we do it? Why do we bother making this report? I think the better question to ask might be, why doesn't every plan? Why isn't it required? So I think naturally, if you buy something, your question should be, how much did it cost? Especially if it's not your money, right? We're using taxpayer funds, public funds. And so if you ask those plans that don't do this kind of analysis, they'll tell you that they look at net of fee returns. All right, that's the shortcut. And for them, what really matters is what you earn at the end. That's an argument that I will echo, and I've echoed that at the IC when we talk about some of our more expensive hedge funds, right? Please focus on the net of fee returns. Does it really matter what the fees are if the net of fee return justifies that investment? So at the single fund level, that argument works, I think. It makes a lot of sense at the single fund level, but at the plan level, when we're talking about the plan's expenses overall, it masks a lot of nuance. If you think about what you're doing at the plan level, it starts with you all trustees at the strategic asset allocation level, you're making a lot of trade-offs, right? It's public versus privates. For staff, we chime in on active versus passive, fundamental versus systematic. We're making all of those kinds of decisions to put together a plan that produces that net of fee return. And so the production of this fee report, it gives us some context into how well we make those trade-offs, right? The level of expenses and fees tells us how efficiently are we producing that net of fee return. So Harrison will show at the end of the presentation that as we look at the numbers, the plan looks pretty good along efficiency metrics, right? We're controlling what we can control in terms of management fees. Our fee pattern is aligned with our managers, right? We do well when they do well. That we pay more, but it's when those performances are high. And generally, we can say that we're paying at or below market rate or the types of managers we're involved in. So I'm going to turn it over to Ron. He's going to walk through the numbers, and then Harrison's going to finish us.
Good morning. As every quarter, representatives from Makita and Newberger present the quarterly net returns, which are reduced the fees, the expense paid to the managers. Usually in the industry, the actual underlying fees, pension plans are reporting the financial reports, such as the CAPR, and only show the fees that are invoiced only, not the ones that are charged by the fund managers. We try to present this fee on an annual basis to give you a full picture of the costs associated with the investment program. As Jay mentioned, this is our 10-year anniversary of doing this. So, so we have good size of data regarding what's important. To start with, we should understand what comprises of the total fee expenses. The net returns are presented by the gross returns, net of management fees and incentive fees, as well as the operating fees. Management fees are fees paid to the managers. Incentive fees are tied to the performance of a fund. Operating expenses are initiative costs of running a fund. And the other expenses show us the costs incurred by fund levels, such as staff salaries and consulting expenses. In terms of data collection process, we started by sending out the fee template to all the private fund managers. I'm sorry, all the public fund managers, and the ILPA template to all the private fund managers. Scrub the data, clean the data, look for outliers, gather the underlying fees, and cross-reference it with their own fees, as well as gather information from other sources to present this digestible data. For the pension plan, the top table shows that the plan's 2024 calendar year fees and expenses broken out in various fund types, such as passive, active, hedged, and private strategies. The plan's management fee and incentive fees, along with operating expenses, were 55.6 million, which accounted for 107 basis points of the plan. Below that, you'll find that the plan level, we had 3 million in added costs, representing 6 basis points expenses, which is lower by 1 basis point from last year. For the healthcare trust, the management, operating, and incentive fees were 0.4 million, which is 13 basis points of the trust. This is lower due to primarily investing in passive funds, which was about 84.7% weight. In the table below that, other costs were 2.2 million, which was 6 basis points of the expense of the trust expenses, and which is also 1 basis point lower compared to last year. Now I'll hand it over to Harrison, who will review the rest of the presentation.
Hello, everyone. So now we'll look at the total expense ratio over time slide. So here we have the total expense ratio over the past 6 years broken out into management fees in blue, incentive fees in beige, and operating expenses in brown. Below that, each year has its respective plan net return below. Comparing 2024 to 2023, the plan expense ratio increased from 97 basis points to 107 basis points, mostly due to an increase in management fees and a slight uptick in incentive fees, while operating expenses remained constant. The plan overall returned 9.7% in 2023 and 8.6% in 2024. A $5.4 million year-over-year reduction in private equity incentive fees offset an increase of incentive fees in growth real estate, venture capital, and market neutral strategies, leading to a marginal 2 basis point increase in incentive fees. The increase of 9 basis points in management fees was a result of increased commitments toward private market strategies in 2023, and now we are seeing a full year in 2024 of this extra commitment in effect. Now on to the next slide. We can control management fees. In this graphic, we have our management fee ratio plotted over the past 10 years. We can observe that the management fee ratio has steadily declined over time, ultimately plateauing around roughly 55 to 60 basis points on average between 2020 and 2024, but ultimately trimming 18 basis points over the period of 2015 to 2025. We've reached this approximate 55 to 60 basis point plateau as management fees are mostly driven by asset allocation, and unless that changes significantly, it'll stay near this range likely in the future. Here we have a graphic representing the contribution to management fees by fund type. This is broken down into public, private, and hedge funds, all within the active strategy type. So this is excluding any passive funds. In this graphic, we can observe the brown bar sitting on top, which shows the hedge contribution to fees declining overall since 2017, playing as a big driver of the reduction, progressing from 36% from 30 basis points all the way down to 6 basis points in 2024. We see that compared to 2023, public and hedge contribution to management fees has remained relatively constant, but private markets contribution to management fees has increased by 10 basis points. A common theme we've seen throughout our report and analysis, market maturity and development of our robust private markets program. So now into the value added from active strategies. This slide shows the value the investment team has added through active manager selection. The blue bar shows the low cost passive portfolio, which is representative of the same target allocations that we currently have, but if they're managed exclusively on a passive basis. And the orange bar represents our annual return net of fees. The 3-year period returns on the left were 40 basis points annually of value add for the plan, with a cumulative value add of $59.2 million. And the 5-year annualized return on the right had a value add of 130 basis points per year, with a cumulative add of about $315 million. It's important to notice what is not in this graphic, and that's fees. When we go through our quarterly performance report with the board, fees are rarely mentioned. This is because our primary objective is to deliver alpha through manager selection and excess returns to exceed our discount rate. And our secondary objective is to minimize fees, again, touching on what Jay alluded to earlier. If our primary goal was to minimize fees, we'd just replicate this low-cost passive portfolio, and this represents the value of hiring active managers for the fund through the due diligence process. So now this table here shows our estimated fee savings in 2024. This $12.4 million of savings in 1 year is achieved through manager negotiations, early investor discounts, and size-based discounts. Hopefully this table exhibits our dedication to efficiency in terms of minimizing costs for the plan and ultimately its beneficiaries. That concludes our presentation. Thanks, and are there any questions?
Any questions? Ida?
2 questions. One is, how do you measure savings relative to fees? What other investors are paying, or? And the second question is, it sounds like this support, I mean, this was a concern with the plan 10 years ago, and you already demonstrated that the fees are, going down. And given the amount of effort involved, is there a simpler way for you guys to do this and still make the point? It sounds like it's a lot of effort.
It is a lot of effort, I think. I didn't mean to imply that it's so much that we want to stop doing the report. I think our intention was just to show that staff is making a dedicated effort producing these numbers, because as I started off the presentation with, I think it's a necessary part of being fully transparent. So we certainly plan to continue doing this going forward. I would call it a highlight program. As for the fee savings, I believe those savings are generally measured from the headline prices of the fund. So, a fund will market themselves announcing a certain price level, and then they'll offer a range of discounts below that for size, consultant aggregation, and so on.
Okay.
I just one question, Jay. On slide 6, and maybe that's for Harrison. What was the reason for the increase in the management fees? 2024 on slide 6. Yeah, it goes up to 65 basis points.
Yeah, so most of this increase in fees is attributable to the maturation of the private market strategies.
Okay. And that's also a reflection of the fact that you're looking for alpha. And so I assume that you're getting higher returns for the increase in the private markets.
I would love it if it'd be too simple, right? If you actually got what you paid for right away. So generally there's some correlation over time, but the expectation in making the private fund that mix of assets is part of the whole plan. And we can
And one thing to add also, a year and a half ago, the board approved an increase in the private markets allocation from 25 to 20.5%. And for private funds, we usually pay fees on committed capital. So there's a process where fees go up till that capital gets invested. So we're in that process, and that's why the management fee went up. We also have a more detailed report, the second attachment that has an attribution. So 8 basis points of this 9 basis points change is purely due to private funds.
Okay, all right, thank you.
I appreciate this report. As you pointed out in here, control what you can control, and management fees is, it's basis points are up to 1%, but every basis point counts. So thank you on that. And this is great. My one question is on the incentive fees. How much effort are you putting in reviewing those with regard to traditional management fees to make sure those relationships are appropriate and we're not overpaying on incentive?
Yes, so most of the, obviously, most of the fee negotiation comes up front. Like we're making either the commitments or we're joining, say, a hedge fund with some kind of performance fee layer. So at that time, we're surveying the market environment, looking to see what the market level of performance fee is. For the ones that we can go back and revise over time, say, slightly more liquid hedge fund type exposure, we're looking at the mix of alpha between the manager and ourselves, and see if that stays competitive within the market. For privates, certainly you make that commitment, you're in. And so you're on a forward basis for the next commitment, maybe it's next in the series, that could be a point of negotiation.
Thank you.
Question.
I don't know what page number this is. This is titled Value Added from Active Strategies. This chart here, is this for the whole plan, both the pension and the healthcare trust? Or is it just the pension? Just the pension. Just the pension. Do you have one that shows healthcare trust? I'm assuming that healthcare trust looks okay, right? Or similar?
Yes, remember, keeping in mind that the healthcare trust is largely passive.
Yeah.
Because of the nature of it being closed fund essentially. So the liquidity requirement is different than in the pension. So the difference, I guess, for the chart, the net return for the low cost passive portfolio should be very high. That make that.
Okay, and maybe at some point I'd like to see that too, because I mean, there's some active strategies here, so. I was thinking about, if it look good or
Yeah, I
better than.
think it's great, but wait, numbers.
Yeah, just trying to help you guys look better. Second question is, kind of extrapolating here, looking at the trend. Dinesh, as you said, we're gonna have an increased allocation to private. So my suspicion is that next year, when we look at this, it's gonna be worse.
Let's see, so next year's report will be based on calendar 2025.
Because we have an increased allocation to private, and we pay fees on committed capital. And so I don't think there's gonna be value added from the beginning. So it's gonna look worse, right? I mean, if you have to project what that would look like, what do you think?
Yeah, my only hesitancy is around the level of, I'm not sure where those are coming. Yeah, but I would expect.
Well, I was thinking, sorry, you have a 3-year and a 5-year. I mean, do you guys calculate it 1 year?
1 year value from active strategies? Yeah, certainly that shows up on the.
If you do that, do you have a sense of what the trend would be next year? For these numbers?
No, I don't, off the top of my head, but we can certainly pull that.
Okay, thank you.
I would guess it might be actually negative because public markets have been exceeding private
Yeah.
markets, so there is a lag in private valuations where
Yeah.
public markets have been,
That's what I was thinking
Yeah.
too.
so I would expect it to be negative
These would be high, but bonus would be,
during that 1 year period,
Yeah.
yes.
because then that gets rolled into your 3 and 5. And so that's why I was thinking. I mean, yes, cool, but I don't know how much, and I was just wondering.
Also
Thank you.
depends on what the numbers are rolling off. So what the 5
I
years.
suspect all the good ones are rolling off.
And you did this report annually?
Yes.
I mean, if we have such a large private allocation, would a 1 year horizon even, be a fair metric, even sort of feel? Yeah,
No,
so
it's not,
I'm defending
yeah.
you guys. But,
Yeah, that's probably too short to judge performance, and that's why we try to pick some longer time periods
Right.
here.
Being allowed here.
But that will still impact the 3 and 5, that's what I'm just saying. My thinking is that when you look at this next year, it's gonna look worse. So
Sure,
just trying to figure out how we can get ahead of this.
fair enough.
Any other question? Well, I think this was just a presentation, so there's no further action on it.
That's right.
Thank you.
Okay, moving on to item 3, old business. Discussion and action on pension economic assumptions for the June 30, 2025 actuarial valuation. Be presented by then Chiron.
So, Mr. Chair, can we take our new business items at the same time as the old business? Happy to wait and let you start the new business agenda, but kind of all flow together.
We can discuss them together, but the actions would have to be taken separately.
Yes.
Yep.
That's fine.
Okay.
So if you'd like to start off with the new business and combine them.
Yeah, we will. Okay, you share my screen with me? Okay, we're gonna start with the preliminary pension valuation results. And then move forward from there. Screen. So just as a reminder of our schedule, this meeting, we're presenting the preliminary pension valuation results, demographic experience study, and as well as revisiting the economic experience study or review of economic assumptions. And then finally, we are reviewing assumptions for the OPEB plan. So there's a lot of assumptions that are going to be thrown at you today. All preparing for the December meeting where we'll present the final pension valuation results.
Sorry to interrupt, but which item is this? The presentation I have here looks different.
It's 4C.
4C. Thanks.
So first, we'll start out with looking at the assets and the investment performance. What we're showing here on the left side is the historical asset returns on the market value basis, which are the blue bars, and then on the actuarial value basis, which are the green bars. And you can see the last 3 years that the return on the market value has exceeded your assumed return on assets. And that has given you some good gains on the asset side. The most current year in 2025, the return was 10.4%. A gain, and also on the actuarial value side of about 8%. And as you know, you smooth in asset gains and losses each year, over a 5-year period. So that's why the actual value is lagging just a bit because there are some deferred gains. And then looking at the chart, where we chart the market, against the actual value of assets, you can see that the blue line is the actual, the market value, which is much more volatile than the actual value. And now, in 2025, you can see that the market value of assets is slightly higher than the actual value, where we'll be recognizing those deferred asset gains over the next 3 or 4 years. So then we're going to turn to the membership trends. And we're going to first just look at the active membership over the last 20 years. So the membership for the Police and Fire Pension Fund was at a peak back in 2007, and it took a pretty significant decline in 2011 after the Great Recession, and it's kind of stayed low at that point. It started recovering back in 2018, but you can see the last 3 years or actually the last 4 years, that those active membership counts have been declining, and there was a slight decline as well this year. And that's mostly this year's decline was on the fire or the police side, where you lost about 15 positions or 15 active members compared to last year. To note though, the tier 1 and tier 2, you can see in the different colors, the tier 1 are the dark blue bars and the teal bars are the tier 2. And now tier 2 makes up over 50% of your active population.
Okay, so I would look at how the unfunded liability changed this year. We started with, and this is on the actuarial assets, we started with an unfunded liability of 1.1 billion. And our contributions paid for the new benefits being earned, interest on that unfunded liability, and reduced the liability by 79 million. Investment gains, and this is after they're smooth, so this is the smooth figure, reduced it by another 64 million. But our liability experience, we had losses of about 52 million compared to our assumptions. And we'll get into that in more detail, but it's mostly salary increases is what caused that. And so before making any assumption changes, our unfunded liability on the actuarial value, which is what we use to base contributions, is about $1 billion, down from 1.1. This chart, we show the historical changes in the unfunded liability by 5 key sources. The gold bars are the investment gain or loss on that actuarial smooth value, so things are spread over 5 years. And let me just isolate on that one for a minute, because I think that's something. So the other thing is, bars going down are good, bars going up are bad. And so we went through the first part of this decade that's shown, we had consistent losses on the investment returns. But the last 5 years, we've had gains on the investment returns, reducing our unfunded liability. So that's a good story and a good turnaround. The other consistent piece that has been driving our unfunded liability down is the contributions. We have pretty high contribution levels, and those are driving that unfunded liability down consistently from year to year. Over the time period we had during the first half of the decade, there were a lot of assumption changes, most of them increasing the liability. We did take a step back in 2017 with both mortality improvements. We had less mortality improvement projected, which reduced our liabilities, and lower salary increases. lately, the issue that has hit us harder are the liability losses, and most of those have been related to salary increases after the spike in inflation that we had earlier around the COVID time period. It's not much in the way of benefit changes, but if you add it all up, the only piece that has consistently over that period dropped the unfunded liability is the contributions. The investment returns are becoming a more positive force as we move forward, dropping off those negative years early on and looking at the positive years, the last 5 years.
Can I interrupt you real quick? I have another question on this topic.
Sure.
You mentioned the salary increases or wage increases as one of the drivers of this. Is that related to a topic we talked about last month, and that the salary increases are above what we're anticipating salary increases would be when you do the actuarial assumption? Okay.
And that's, you're not unique. That's something we're seeing everywhere because, in some sense, it's a response to the inflationary period we went through. Salaries didn't increase immediately, but there's been a lot of pressure to increase salaries following the spike in inflation.
Okay, thank you.
So moving on to the actual evaluation results, looking first at the funded status of the plan. On the left-hand side is the 2024 valuation. On the right is the current year's valuation. And the accrued liability is just over $6 billion. And you can see that most of that liability are for the members who are in pay status, your retirees, disabled members, and beneficiaries. They're reaching about close to 75% of the total accrued liability of the plan. And the good news is for the funded status is both the funded status based on your market value and your actual value of assets have increased 83% to 87% on the market value, on the actual value 82% to 84%. Looking at the different tiers and their makeup, you can see that doesn't change much when I just show you the tier 1 liabilities because they make up most of the liability because they have all of the inactive liability. And then looking at tier 2, all of their liability or most of their liability is from the active members, and their current funded status, they are over 100% funded. And if you recall, the tier 2 members would pay part of that unfunded accrued liability based on the statute. They pay 50% of it if there was one, but currently right now it's just normal cost.
And I got a quick question. I just want to make sure I heard this correctly. You said 75% of our fund is represented by in pay status.
And a small piece of inactive.
Yeah, and deferred.
So yeah, that's very small.
Okay.
Yes. That's very mature. Most plans, or a lot of plans that I encounter, that ratio is closer to 2/3, 66-67%. So you are a bit more mature in that regard.
Thank you.
Turning to the preliminary contributions of the fund, on the left-hand side, we have the contribution rates, and on the right-hand side, the contribution amounts. What we're showing here includes member contributions as well. You can see there's been a decrease in the total contribution rate from 89% to about 86%. In terms of the member contribution, I just want to point out here that it went from 2.7% to 2.9%, and that is not an increase for the member rates. It's just a demographic shift from the tier 1 to tier 2 because the tier 2 members have a higher contribution rate. So the more majority of the system is becoming tier 2. So you're going to see the average weighted contribution rate for members would be increasing there. So if you look just at the city contribution, the city contribution rate decreased from 76% to about 73%. And then inversely, the contributions themselves actually increased slightly. And I'll talk about that dynamic in a minute, but the biggest decrease that you see in the contribution rate for the normal cost and the unfunded accrued liability is that unfunded accrued liability payment piece that is going down. And the reason that that is happening is that your UAL payments are structured so that they're going to increase with that inflation rate of 2.5%, the assumed inflation rate. So that's why you're seeing the UAL payment dollar amounts going up. But even though your active membership decreased a little bit this year, the active payroll increased by 6%. So those pay increases that the active members are getting did increase that payroll. So your payroll grew faster than your unfunded accrued liability payments. So that's why you're seeing a decrease in that unfunded accrued liability payment, but an increase in the dollar amount of those. The asset gain did decrease the UAL payments slightly, but it's still the existing layers did increase by that 2.5%. Now, looking at the contributions by tier, you can see that, again, tier 1 makes up the bulk of the contributions, just over 200 million, while the tier 2, about 25 million. And that increase for the tier 2 is just the normal costs being paid by those, or normal costs that's accruing for those active members. And it's increasing because that tier 2 payroll continues to increase with salaries and with more active members.
Just wanted to show that the tier 2 rates are not going up. They're pretty steady for the members and for the city. So that's our presentation on the preliminary results. We do have in here additional details.
Can I interrupt with a question?
Yeah, absolutely.
And going back, I was just curious with the membership trends. If the support ratio is, I don't know if it's possible to know this forecast, if it plateaus somewhere just below 2, how does that work does it work into the assumptions? And when you do the calculations on UAL, I mean, how does that affect the forecast?
Well, when we are looking at the population, when we do our valuations, we assume a stable active population with our valuations. But in terms of the retiree membership, we do would be projecting that overall that population will grow because more people are entering retirement than are leaving. So, but in terms of the active population, that is a stable population when we do the valuations.
Okay, so you do a forecast on what that ratio is going to look like? Support ratio.
We do. If it keeps growing, and we'll go through this next month, it makes you more and more sensitive to changes. It is the big takeaway. So your contributions become more volatile with differences in investment returns and differences in changes in assumptions.
Okay, all right, great, thank you.
How many other plans are like this in terms of the percentage split?
So
It sounds like a lot. We're up there.
you are up there as a very mature system. So police and fire systems tend to be more mature than other systems, but even among the police and fire, you're very mature. We will have well, you can get it from our website, but we have data on that on the California survey, and you can compare yourself to Los Angeles Fire and Police. Is a good comparison, but you're significantly more mature than they are.
But most systems are above 1.
Yeah.
1.5.
David, too.
Close to 1.5.
David, too, and I think Woosley will back this up. San Jose's kind of has a history of not hiring what they need. we operate a very large city with a lot less cops than most cities. So when we've got more people going into retirement and collecting, and we're not putting them back, and you saw the chart earlier, our numbers just continue to drop. That's one of the things that I think puts us as an outlier.
Yeah.
On it. When you look at like an LAPD, Dave came from there. I mean, what are the size of their academies?
I mean, a long time ago it was 100 a month. Now I don't think it's that many, but we're maybe 100 a year, and we lose 100 to 125 a year. So we're not able to keep up. For one reason or another, we're not keeping up with new hires pay into the system to cover more of the people that are leaving the system.
So, Bill, I would ask, how are we compared to like a San Francisco or San Diego?
Off the top of my head. Well, so both San Francisco and San Diego have their safety and their miscellaneous or general members all in the same plan. And so when you look at the plan as a whole, they are far less mature. And so I don't have a good sense if when you just pull the safety members out. But I think they're, at least for San Francisco, I believe their safety active members have been more stable than yours.
I guess I'm just more clued in. Every year I'm sitting on the board, more clued into the potential volatility of the required contribution rate because of the maturity of your plan. And so the last couple of years, returns been great. So, we don't
Right.
think about these issues, but when returns are not good, then it's an issue that may be very difficult to deal with at that point in time. So I'm always going to ask the question, how can we mitigate this risk? I mean, I don't have an answer, but if you guys have any thoughts, I'd love to hear it.
Well, that was one of the things we were trying to address in the retreat is a possible mechanism to that. But it is a difficult thing to manage because there are trade-offs. The sensitivity, as you point out, works both ways. So when we have good returns, having a very mature system really accelerates the benefit we get from those good returns.
First of all, I always appreciate your presentations. They always make me more, knowledgeable about the plan. I had a question on whether there was any lesson learned from the two. Were you the actuarial consultant back in 2017?
Yes.
Okay, so I'm just curious, was there any lesson learned? Because that was a dramatic difference in the assumption, the impact of the assumptions. Volatility generally comes from the investment returns, but I was just surprised to see that 2017. And is that something,
The assumed rate of return in dropping.
or is that just a discount rate?
Yeah.
Effect?
Well, no, the 2017 was not a discount rate. I believe we didn't change the discount rate that year. So that would have been a demographic study. And in 2015, we had done another demographic study and implemented new mortality tables with generational projections that the Society of Actuaries developed. 2 years later, they updated those projections every year. And so 2 years later, we updated to the latest projection table, which showed much less mortality improvement going on. And so there was a seesaw there, putting in much more conservative mortality tables and then backing off essentially between 2015 and 2017. And that, but in terms of, so I think the actuarial profession has learned from that and things have mostly stabilized since then, some continuing to back off some of the mortality improvements that were projected. The piece that we note on the 2017 was the reduction in the the wage increases. We had a long period where wages were really held down. And so then we finally adjusted our assumption down to something closer to what was happening. And then that was just on time for things to swing around and kind of balance out over the longer period. So it is kind of, I mean, this is a great entree to the next presentation on demographic assumptions. You don't want to overreact too much to recent experience. And the question is, how long of a period is that recent experience before you really react to it? And there's no like formula you can follow on that. That's a sense of judgment.
Thank you. Thank you for a really clear explanation. Appreciate it.
Okay, if there's no other, I think you can tie it into the other one. I think that was just a presentation, no action on.
Correct.
Or Steve.
Okay, so now,
Still, just to clarify for the group, we're going to 3A now?
no,
No, okay, where are we going?
or C 4D,
4D, okay.
4D, and we will revisit 3A at the very end of this presentation.
Gotcha. Okay, 4D.
My slides. Okay, so last month, we reviewed the economic assumptions. And there were no proposed changes except for the wage inflation. We had recommended 3.25%, going from 3 to 3.25%. That whole range we consider reasonable, and there was discussion about looking at the midpoint of that range. So that's what's out there on the table for the economic assumptions. But we want to go through we wanted to give you the update that we just gave you on where the preliminary numbers were before any assumption changes. Then we want to do the demographic assumptions, because usually there's not much debate about those, and incorporate those costs in, and then revisit the economic assumptions and consider the impacts of those alternatives, right? So that's where we're going here. Again, this is looking, the demographic assumptions are going to affect our liability gains and losses, not anything to do with investments. And so we started off by just looking at the sources of gains and losses over the last 5 years. And you can see here that the green bars are salary increases that were greater than what we expected. And so that has dominated our gains and losses, or in this case, our losses for the last 5 years. Now, they look really large on this chart. I do want to point out that the total liability is 6.4 billion. And so the total loss in 2025 is about 0.8% of the expected liability. So while they look large on the chart, in the overall scheme of things, they're not enormous losses, but it is important to keep track of this. The other assumptions, the gains and losses are much smaller. And so You'll see us look at some tweaks on those in the demographic assumptions, but nothing major.
On this chart, the green bars, is the zero. The current wage assumption, and the green bars is above the 3% that we're currently assuming.
Correct.
Okay.
So it's above the assumption. It could be either the general wage increase or it could be the steps and promotions.
It's inclusive.
It includes both of those. So those are not separated out. And so as part of the demographic study, we'll first look at those steps and promotions that are based on years of service. And then we'll come back to the wage inflation piece of it.
Thank you.
So this is our quick summary. The merit salary scale, merit and longevity, that's the promotions, step increases and so forth. And so we're making some adjustments on that that are relatively minor adjustments, other than the special adjustments for the police officers agreement that brings in longevity and crisis training pay. So that's a material change that only affects police officers. And so we'll talk about that and you'll see that. The other assumptions, retirement rates, we're moving down a little, very minor adjustment to terminations, some updates on mortality and updates on disability, and the females married at retirement. This is the minor impact of the changes. So we'll walk through the big changes here.
So as Bill mentioned, we're looking at those salary losses every year. It includes both the overall wage inflation and this merit salary scale piece. And this is the step increases or promotion increases. And this assumption is based on how much service a member has. So we have one scale for both the police and fire, and the base scale is shown here on the left side of the slide. The actual experience that we're seeing, and this is over a 10-year period, are the gray bars in the line, and then the current assumption is represented by the blue line. We are proposing slight decreases in the merit scale early on in a member's career, but then when they reach 8 years of service, we're proposing increasing the merit scale slightly just to be more in line with the actual experience that we're seeing. So in addition to this base merit scale, we are proposing to include the most recent POA agreement into these merit scale. And again, Bill said this is just for the police officers. There are two pieces that affect the pensionable pay for the police officers in this POA agreement. When a member reaches 20 years of service, and they have different effective dates. So the first is this crisis training pay, 3.75%, and that is going to become pensionable for members. And then the longevity piece, so a portion of the longevity when a member reaches 20 years of service will be pensionable at the 1.25% level. The total longevity is 4%, so just a portion of that is going to become pensionable. And to be clear, these members are receiving this pay in their paychecks, right? Their take-home pay, but it's not being used to calculate their pension benefits prior to this POA agreement. So we will build our model to incorporate these new increases to project salaries, which are going to be used to calculate the pension benefits at retirement, right? And when we actually value these benefits, we look at what the projected benefit's going to be, and we calculate a normal cost rate. And we say that all the time, right? And that normal cost rate, we calculate that to be a level percentage of pay over a member's career. So that's why we're incorporating it now, so that we have that new normal cost rate for these members, rather than when it becomes effective or when they reach 20 years of service. So just wanted to be clear on that, because there was some perception that maybe this wouldn't affect the pension plan cost until it was effective or until these members actually reach 20 years of service. Are there any questions on that one? Because that is a bigger cost driver for the active members.
So for the demographic study, there's this presentation and then there's a voluminous report that has all kinds of charts and graphs and stuff in it. I wanted to spend just a minute talking about the statistics we're using that are in that report to help you navigate it if you want to go through the details. It also shows up in the few slides we pulled out to highlight things here. But one of the things we show are confidence intervals. And the idea here is the more data you have, the more confident you can be in the rates you're observing. And so if you just think about if you observed a 10% retirement rate, but that was based on 10 people being eligible to retire and only one person doing it, using a binomial distribution, all we can say with 90% confidence is that that rate's somewhere between 0 and 30%. And so we don't really know. But if you had 10 out of 100, that range narrows considerably to between 5 and 15%. And if you had 100 out of 1,000, that range narrows even more to between 8 and 12%. So our charts show these confidence intervals so that you can get a sense of how much data there is in a point and how much we should be concerned about our assumption not matching exactly what the observed rate is. Generally, we're going to try and propose rates that fall within the confidence interval. There are some exceptions when we get, you'll see we'll have patterns of rates like retirement rates. We're looking at different ages and there will be some piece that's like an outlier. And so we may not stay within the confidence interval for that piece. We also do make adjustments for future expectations. I don't know that there are any significant adjustments for future expectations in this analysis, but often we will have experience that we don't expect to continue in the future. And so we have to make some sort of adjustment just based on judgment, understanding that the environment has changed. For the most part, we're using 10 years of data. We do this every 2 years. So we've dropped off 2 years of data and added 2 more years. That gives us some stability to the data we're looking at. We did look at the years of the pandemic by themselves to see if they were anomalous. For the most part, they didn't materially move the assumptions, but we do take that into account. The other statistics, key statistics you'll see are the actual to expected ratio. So if we were looking at retirements, we looked at the actual retirements during the period versus what our assumption expected and calculate that ratio. And ideally, you want that to be close to 100%. Then we also look at what's called the R squared statistic, which if we have a series of retirement rates, things may bounce around. We want to make sure our rates are bouncing around and taking into account that variability by age or in termination by service. And so this statistic helps us calculate how well the set of assumptions fits the set of experience.
So these things like demographics, do you look at it every year based on a 10-year rolling, or it's like every 5 years you?
Well, so normally we would like to look at it every 3 to 5 years. By statute, we have to look at it every other year for this plan. But yes, it's that 10-year rolling is It is one mechanism we use to make sure we're not making rash changes just based on 1 year of experience.
Excuse me, I'm sorry, that's based on local statute?
Yeah, that's San Jose.
Is that abnormal?
Well, the state of Oregon has a similar one, but, those are the only two I know of.
San Luis Obispo County does it every 2 years.
But mostly it's 3 to 5.
Yeah,
So all the California county systems are required to do it every 3 years. Federated does it every 4 years, which is what CalSTRS does. And CalPERS in San Francisco do every 5 years.
Is there a way to calculate the?
Dave, can I just remind you to turn on your mic?
Oh, yeah, sorry. Yeah, is there a way to calculate the cost benefit of doing it every 2 versus every 3?
I'm not sure how to calculate that
Sure,
cost
okay.
benefit. I would. Even though the cost benefit to the actuarial firm is greater if it's every 2 years.
Right. But to the plan.
But to the plan, I would suggest 3 to 5.
Okay, thank you.
so just to summarize again, most of these changes that we're making to the demographic assumptions are really just tweaks. Because there wasn't a lot that was going on in this 10-year period versus the last 10-year period. So first, we're looking here at the retirement rates. We do look at the retirement rates separately for police and fire, and we look at them based on age, but also we look at them based on different service bands, because members generally who have more service will have different retirement rates than members with less, because their benefits are higher. So here we're looking just at the tier 1 experience, because the tier 2 we don't have it's very sparse still. And generally speaking, there are lower rates of retirements that we were seeing in this 10-year period than the previous period. So you can see that for the fire on top, the current assumption with the A&E ratios are all less than 90%, and we're proposing to decrease the retirement rate so that we're more in line with the actual experience, but we are not going all the way to that 100% level for the actual to expected ratio, because we want to build in a little level of conservatism, and we don't want to overshoot what we're seeing in this 10-year period. We did look at the last 2 years, because that's the new experience that we have for this study, and we did see lower retirement rates for those 2 years. So that's partly how we based our proposed assumptions.
Yeah, let me just add to that. Not only were the 2 years we added among the lowest, the 2 years we dropped were among the highest. And so we ended up seeing a bigger shift than we would normally see in a 10-year period.
And similarly for the police, you're seeing that those ADE ratios are well below 100, and we're proposing decreases in the rates so that we can put our assumptions more in line with what we're seeing in this period. We did make just a couple adjustments to the tier 2 retirement rates for the over 30 years of service timeframe, because we wanted to keep those rates in line with what we were doing with the tier 1, so that when you looked at the two of them, that made sense, that we weren't assuming that the tier 2 would retire at a faster rate than the tier 1, because we're dropping those tier 1 rates.
Can you explain what those numbers, so if you, let's take fire 25 to 29, so actual to expected, right? So what does 67% actual to expected mean?
So that means that if it's just, actuaries like to slice and dice, right? Let's say there was 0.67 of a person who retired. We assumed that there was one person who would retire. So it was fewer retirements than expected, right? And so by changing the expected or the expected rate and lowering it, it increases that ratio. Does that make sense?
Okay, I had to think about it.
And so we expected 100 people to retire and only 67 did. And so then So we're changing our expectation,
Right.
to make that. Go ahead.
But where is the expectation on this chart?
I'll go to the next chart, make things a little bit more clear. So now we've charted our, the experience that we're seeing, and this is that 25 to 29 year of service cohort for the fire and the police. And so on the left-hand side is the fire, and you can see that each age, we built that confidence interval that Bill was talking about where within 90% we can be confident that the true rate lies. So, so the blue line represents our current assumption, and then the green line represents what we're proposing for that assumption. So none of these charts have the actual numbers where we calculate that A to E ratio, but just showing in the direction to where we're actually moving. And we, for example, we did not move the rate down to the confidence interval at age 52 for the fire, because we really didn't see a reason why there'd be different behavior than at 51 or 53. So we just kind of kept a steady rate for all of those ages that the rest do fall within those confidence intervals. And when you see both police and fire have just a dot at 60, that means there was no experience at that point, or there was 0 retirements and no exposures. So, and again, you can see that we haven't gone all the way down to where the actual rates are for some of these intervals, just because we want to keep that level of conservatism in there, and we don't want to overshoot lowering the rates where maybe we'd see somewhat higher rates in the next couple of years. So it's just inching towards that experience.
And this, I'm sorry, and this is looking at age at time of retirement.
Yes, at time of retirement.
Okay, so just to make sure I'm reading this correctly, the current assumption that you have is at age 50, about 45% of people are going to retire.
Right.
And the observed was probably like, what, 34%?
Right.
That is.
And then we're
Okay.
coming down to 40%.
Got it.
And not going all the way to the experience.
And if you prefer all the numbers instead of the picture,
can
then you
look
have to
really
open the
big.
report.
Yeah, and you can see all the numbers that are calculated there, yeah.
So one question, how do you overcome the fact that, first of all, this is not a very large number, the denominator is not that big, and then you're slicing it into these smaller buckets. So at what point do you feel like, 40, just the numbers itself are not statistically significant?
Well,
on the population?
that is why we put
Right.
the gray bars there
Right.
in the confidence intervals so that you can see. Now, when we're developing the assumption, like if you look at the police chart on the right and the older ages, you can see that the bars get pretty wide. So you don't really know if you look at each age. To come up with that flat rate that's in between, we just combine the experience for all those ages to
Got
get
it.
an average and then.
Okay, you did say that, sorry.
Yeah.
And then that confidence interval tightens because you have much more experience to base it on.
So would you consider this a pretty significant change? Because the looks high, 45 to 30,
Well,
40.
the reason it's not quite as significant is there aren't as many people at those ages. And we'll go through the cost impact of what these assumptions changes do and what happens and how they affect the accrued liability and the member rates. So, and again, that's why we did not go all the way to the experience. If you go back and you look at the proposed A to E ratios, they're all still well below 100%. To keep that in mind, not going too far, yes.
And even at 50 years old, the current is actually really at the edge of the confidence interval. So statistically speaking, we can't actually say it's different.
Right, we could leave that one there.
I'm not saying we should.
Right.
That's where the judgment comes in. Yeah. And, you could have 10 actuaries looking at this and they each would probably come up with different sets of assumptions. In fact, that's kind of what we do is we go back and forth and make recommendations and the other person tweaks it and we come up with what we think is reasonable, so. Okay, moving on to the termination rates, we are proposing no change for the police termination rates because they're really consistent with the current assumptions. We are proposing just some slight reductions in the termination rates early on in the fireman's career from when they have 0 to 3 years of service. So that will bring that ADE ratio up from 80% to 94%. Again, not moving the entire way to 100 to leave some room. So moving on to mortality. So we are recommending a change in mortality. It's mainly due to a new table that the Society of Actuaries came out with recently in the last year. We were using what was called the Pub 2010 table, and now they've come out with a Pub 2016, and these are a group of tables that are only for public sector use, and they're based on an analysis just with public sector mortality. So there are different tables for general members, safety members, and teachers. And so we're proposing using this new table. It does have a better fit to San Jose's mortality rates by age. There are lower mortalities at younger ages, and now the new table then has also higher mortality at older ages, and that's what we're seeing with the ADE ratios. You can see at the younger ages, those green bars are increasing, the ADE is increasing, which means we are lowering the mortality, expected mortality. But then at the higher ages, those green bars are coming down, which means we are increasing the number of deaths that we are anticipating. So we have all the statistics up here in the chart. We based our assumption mainly on the male experience because you can see with the females, both the healthy retirees and the disabled retirees, there are very, very few female deaths. So that's where we focused the analysis on there. So we are changing the base table, and when we look at mortality projections, there is a new table that the Society of Actuaries came out with as well. The last time they came up with something was 2021, so we have changed that as well.
We've had that. We didn't change.
Oh, that's right. Apologies. We have had that because we do it every 2 years, so we updated that with the last study. So it is just the base table that we're changing.
So let me back up on the mortality a little bit because we were trying to get this presentation shorter, and I think we left some background out that would be helpful, which is mortality. Because rates of mortality are so low, you need a lot of experience to be able to set a mortality rate at each age. And so instead of doing it just based on your experience, we go to a published table, and we're switching to the Pub 2016 tables, and we borrow their rates and we compare that to your experience. And to the extent your experience is credible, we move their whole curve up or down. We don't like move up the mortality at age 50 and down at 51 or anything like that. We take their whole set of rates and either move it up or down based on your experience to the extent we have enough. And so what Ann was saying here is the female experience, we really don't have enough. And so we just applied the same adjustment factor that we calculated for males, applying it to the female version of the table, but just making that adjustment. The other thing I just want to note is 2016 sounds like a long time ago. 2016 comes as the central year of the experience they studied. So I think their study went through 2019 or 2020. They cut it off before the pandemic and went back prior to 2016. But it is the latest, greatest information we have based on national public sector plans.
Another quick question. Used to be the rule was that we wouldn't live more than 15 years after we retired. Is that the same you still use now? Is it different?
Well, it depends on when you retire, but yeah, I think I didn't calculate with the new tables what the life expectancy or retirement specifically would be, but it's longer than 15 years.
Another question maybe for our CEO or maybe, I'd like to know an example. And when we say tier one, is that the 85% or 95 or 90% retirees? I just need some clarification here. And I'm trying to get at is,
Tier 1 is 90.
what's that?
It's the 90.
Tier one, and tier two, is
Different
85.
different calculations, but both 90.
Yeah.
Tier 2 is
85.
80, yeah.
Okay, and then tier three is the 70.
No tier yet. No tier 3 yet. That's right.
It's tier 2.
Because we went back to even the 63, then all of a sudden went back to 70. But I'd like to know if you can, I don't see why you couldn't. How many retirees are under the tier one and how many retirees are under tier two? And,
Most of them, I
And-
think, all are under tier 1.
and I'm not finished. I'd like to know how many spouses are getting benefits from the tier one, tier two,
We can,
the numbers.
right, we can provide,
Bill, can I just clarify something with you? Are you asking how many tier 2s are retired or how many tier 2s are in the retirement system?
Tier one, tier two, how many retired?
So he wants to know how many tier 2s are retired.
yeah, so
It probably only be disability.
And how,
no,
just to
there's,
get what, just to retire, whether it be disability or not, how many retirees we have, tier one, tier two, the numbers, then how many spouses are drawing benefits from tier one and tier two?
so,
In other words, if we have, I don't know, 4,100 retirees, or we have 1,400, it's been a long time. I'd like to know what the numbers are, because
so,
some of this expense to me doesn't calculate, and I'm trying to get it in my head.
so right now, we only have 7 tier 2 retirees.
You have what?
7 tier 2 retirees. All the other retirees are tier 1. And we had, we can go back to the prior presentation where we had the membership chart, we had the totals on there. I don't have right here, I don't have the spouse breakdown or the beneficiary breakdown.
Oh, I know, I'm
But
sure.
we will have that in the valuation report.
I didn't expect you to have it.
Right, no, I understand.
I understand, it had just a little work to find out, but I'm just, it's a curiosity and trying to add up the different costs and what you see here, it just doesn't add up to me.
Trustee Santos, do you want that by police and fire or all together?
Oh, police and fire. Because that, but mortality rate still, to me, the new generation of retirees pay in less and live longer. And then their spouses, well, then receive money, so they're paying in less and receiving more in the long run. And that's, I'm just trying to understand this calculation, so it just doesn't add up to me.
I'm sorry,
Most of my generation didn't make the 15 years, which is unfortunate.
Say that again, please. You think that tier 2s pay less?
Well, because they retire earlier than my generation.
They can't retire until 62
I know,
or 57. I'm
this is a
sorry.
big example. We used to average, say, 27 or 28. Today, maybe it's 25 or 24. And then that's the new generation of retirees. And they live longer and paying less. So that means
I don't think that's experience.
this
Yeah,
is,
the tier twos can't retire until 57, absent some other circumstance like a disability. And that's one of the reasons we only have 7 is tier 2 was created in 2012, 2013. 2013, so there's,
Yeah.
there's only the the oldest career-wise, tier two is only gonna be 10 or 12 or 13 years right now. And they're not, they would be retirement eligible at 57, so if they got hired really late and they did, I think it's 5 years to vest or, fine, and then they could retire, but it'd be, really low percentage of pay. Unless they're disability retirement, then I think they get a bigger chunk and they haven't paid in as much. But the tier ones can retire at 50 or 55 years old. And they used to retire at 27, 28, 29, 30 years of service. And yeah, they might be retiring earlier by years of service, but they still have to meet 50 or 55 years old.
And the contribution rates are nearly identical. They're paying what tier one is paying for a lesser benefit.
What are they?
Plus or minus.
They're paying. a
Well,
little
the
more.
member
Oh,
rate
okay, a
for
little
tier
more.
one is 11%, and the member rate for tier two is 14%.
Yeah.
And their benefits are lower.
The only real difference in that total contribution is that they're paying into Aviva, which is a lower fixed rate, and the tier one are paying into the defined benefit medical program, which is higher. But when you look at their overall payments, they're not too far off.
When you add in the health.
Yes.
Yeah, the current fact sheet for tier one police is 18.39% combined contribution rate on the member side for the employee. And for tier two, it's 17.55, so they're pretty close. And I didn't realize that fire was higher. Fire, the fact sheet says it's 20% on the employee for tier one and 19.01 for tier two. As the member with the employee contribution percentage of pay. And that was as of June of 25. So they're paying very close to each other. But the tier one benefit is arguably considerably better.
Yeah, the offset is just the difference in medical, because they're paying more in pension.
Yeah.
Tier one's paying less, but they're paying less in medical. Tier one's paying more. And then Dave, I think the reason fire's paying more, don't you remember we had that 5-year re-up rule where they could go 1% every year, but 1 year they didn't go to the top?
Yeah,
That's why,
okay.
because we started funding before fire did.
We wrapped up a little bit there, yeah. Thank you.
Any more questions? Okay, we'll move on then to the disability experience. So when we looked at the disability experience, we still use 10 years of data, but we used from 2015 to 2024. We noticed that in 2025, there was substantially lower disabilities, and you see this with every system where you have a lag in disabilities from when someone goes out on disability. Sometimes they will show up in our data as a retirement or an inactive until that disability application is approved. So again, we use 10 years though, and we are seeing in general in that experience many more disabilities than we did in the previous 10 years. And this is partially due to a lag in processing those applications. And so we've seen a lot of more disabilities come through when someone retired maybe or became disabled like several years ago. And so these people were not in our previous study. Looking at the disability experience, again, San Jose does not have enough data where we come up with our own table. So we look to other bigger systems or bigger just national studies. And for us, we look towards CalPERS because they're a huge system, as everyone knows. Our current rates are based on the CalPERS police officer and firefighters at the state level. We are proposing going to the public agency rates separately for police and fire. And basically, increasing those disability rates to be more in line with experience. So both the current and proposed A&E ratios are going from something of like way above 100% to something closer to 100%. And we are making adjustments to those specific tables based on your experience. And again, it's a flat adjustment to all ages, just to make that more in line with what we're seeing at your system.
So you're proposing for fire to go to adjust the expected from 124, whereas for police, you're proposing to move to 100, right? The reason why you're moving one to 100 and
That has to do with how much credibility we have for each of those different groups. Yeah, so we only adjust it as much as we can to the credibility.
It also has to do with where the base table that we looked at would put us. So they were on opposite sides compared to the police and fire experience.
So these two graphs show what the experience was, those confidence intervals, the gray bars, and then our current assumption is represented by the blue lines, and then the proposed is represented by the green lines. And so you can see that there are more disabilities in the last 10 years, specifically at higher ages 50 plus. And it looks substantial, and a substantial increase, but the difference here between the lower ages is that when someone is retirement eligible, their benefits the greater of 50% of their final pay and the retirement benefit. So likely when someone's 50, 55, they will be receiving just the same benefit as they would in retirement. So this doesn't necessarily shift the cost up as much by increasing the rates later on in their career.
Okay, now for the fun part, just putting it all together and the cost impact. So the top line of this table shows the preliminary results from the prior presentation. About a $6.4 billion liability with the member rates and the city contribution rate and amount. And so we broke out the impact of the different changes we're proposing for each of those things. And I think I would note here, if you start with the member rates, the combination of retirement, termination, and mortality and disability and other basically cancels each other out. And so you're left with the impact of the merit scale is the impact on the member rates. The city has a much bigger impact from the mortality change. The mortality change is reducing costs, and so that reduces the UAL primarily for tier 1 retirees, which is paid for by the city. So that's why the city's getting a little more of a break that overrides the increased costs on the merit scale there. In the end, in terms of the actuarial liability, it's 45.5 million out of 6.4 billion. So it's a very minor impact on the actuarial liability. But it does have some impacts on costs. And then this is where we bring in the other wage inflation alternatives, and you can see how those costs would increase the pieces. Now, this is the summary that doesn't break it out between police and fire. And I have to go to the appendix to show you the police and fire breakout because there's actually a bigger difference. I'm going to skip by the board decisions here. We can come back to those. But if we look at just the 3% wage inflation, so this is no change in wage inflation, let's look at the member rates at the top. So for fire, the member rates would go down. For police, the member rates would go up. Now, that's primarily because of the bargaining agreement and adding in the increase after 20 years of service for the longevity and crisis training pay. So that's really what's driving the difference between what's happening to the police rates and the fire rates. On the whole, there's the 30 or 40 basis points going up, but for police, it's more like 80 or 90 basis points, and fire, it's going down. And so that carries forward. You build on top of that. The wage inflation affects both. But if we went all the way to 3 1/4, wage inflation, the fire member rates end up staying about the same. But the police rates go up even more. So they're going up 120 to 130 basis points. So just to be sensitive to that difference, but that difference is really just driven by that bargaining.
So you're calculating in the projected pension ability at 20 years of service plus for today, tomorrow.
Right, so in our valuation, we take everyone who's working today and project what benefit is going to be paid to them. And so, for anyone projected to work more than 20 years of service after the effective dates, we're projecting that higher benefit because they'll have a higher pay.
And they would start paying on that now as a part of their normal cost because you're including it now
Right,
to avoid an unfunded liability later.
right.
And
It's so that we accumulate enough assets to pay that benefit.
sure. And conceivably, if someone were to be paying into that normal cost for the next 3 or 4 or 5 years, and then leave city service prior to reaching 20 years and receiving the benefit as a part of the return of their pension contributions that they would normally get if you leave early, they would get that back.
Right. They
Because
would.
it's just a part of the normal cost.
Yes.
Okay. Thank you.
And I think if it was pensionable before 20 years of service, there are other impacts to doing that. But you wouldn't see the rate increase so much here because it would be spreading. You'd be paying a similar dollar amount because you'd be paying a lower rate on higher pensionable pay for the career.
Right. But this avoids the problem of someone not paying for 10 or 12 or 15 years and at turning 20 years of service, paying in for 1 year and leaving it 21 years of service and getting the full benefits.
Right.
That's what this is trying to guard against.
Yes.
Thank you.
Just on page 15, why does the mortality benefit accrue only to the city and not to the members?
So there is a minor impact on members. It's just not big enough to show up here. But the main impact on the mortality is on the current retiree population, right? And members' normal cost payments are not paying for that.
Yeah.
So that any change in that up or down goes to the UAL that the city pays. It would affect tier 2 if we had enough tier 2 retirees, but we don't. So take more questions or we separated the this 4D demographic study option here. We're asking you to adopt the demographic assumptions, in this presentation and our report, which are summarized here. And then separately, then we would discuss, the wage inflation piece.
So for this piece, the action is to accept your.
Either the 3.3125 or the three.
No,
Next.
we're holding off on that decision right now. This is the mortality determination retirement rates that, we just went through.
Everything on this slide.
Okay.
Right.
And it's just accepting the results and the assumptions.
Right.
Right.
You could make a motion that accepts the recommendations as presented. If there were a want to single something out, you'd have to take a separate motion on that.
I don't have a desire for anything else. I think I'm the one who might have asked for some of this, so I would make a motion to accept the results and assumptions as presented.
I'll second that.
Got a motion from Woosley, second from Gretchen. Any further discussion? All those in favor?
Aye.
Aye.
Opposed?
Okay.
Now 3A.
Now 3A.
All right.
And so I don't believe we took action on any of the assumptions last time. And so just a reminder, no changes to the other assumptions. So price inflation would remain at 2.5. Amortization payment increases at 2.5, and the discount rate at 6 5/8. For the wage inflation, we use the current bargaining agreements for general wage increases. And then the question was, when those bargaining agreements end, do we assume 3%, 3 1/8, or 3 1/4? And so that's what was driving those cost increases that we were going through there.
Can you flip ahead to I think it was the next slide or two from now where it shows what the actual rates would be?
Do you want them broken out between police and fire, right?
Yes, please.
So these are the rates at 3%. And so aggregate tier 2 rates 14.4, tier 1 11.5, but you're essentially reducing the fire rates and increasing the police rates, so they end up very close.
And for 3.125?
3.125, then all the rates go up a little bit. And 3.25, they go up a little more. And so at that point, the fire rates are close to staying level. But the police rates go up substantially. And they end up much closer to the fire rates.
Wasn't your initial recommendation 3 1/4?
Yes.
Yeah, and I had asked for 3 1/8
125, yeah.
to just look at it. A little bit of cushion to the tier 2 members. We're already paying it.
It's like 0.2, right?
Yeah, I think it's 0.2%, so.
Bill, when you looked at 3 1/8 versus 3 1/4, it feels like the bigger jump in percentages happened between 3 and 3 1/8. And the jump in terms of police cost from 3 1/8 to 3 1/4 was,
Well,
as a percentage, a little bit.
it's
smaller.
0.3 and 0.2.
Okay.
It's just a rounding, mostly a rounding thing.
Okay. So it is actually more linear than it looks.
Yeah,
from
it's
the
more
rendering.
linear than it
Okay.
looks here.
Did you have a recommendation last time and did it change?
We recommended 3 1/4 last time. We still recommend 3 1/4, but with the caveat that all three of them are reasonable. In other words, we're not gonna if you adopted an assumption we did not think was reasonable, then we have a whole bunch of disclosures that go into the report.
Right.
So
If we
there's no
wanted to do,
danger of that.
if we want to do something crazy like 3.5 or 2.5 or 5 or something.
Yeah, if you wanted to do 2.5, we might have to.
Got it.
So, and I think we did the 3 1/8 for you to get the visual on it.
Yeah, yeah. I mean, I think I understand the value of going to 3.25. But I'm still kind of stuck on 3 1/8 for my comfort level as one of the only 2 people currently paying in the plan, and I'm a tier 1. It's just a tier 1, so it doesn't affect. Well, it might affect me similarly, but I get a better benefit at the end of the day. And I'm sensitive to the needs of the members that are. I mean, I think you showed in the other chart, the tier 2s are outnumbering tier 1s as a section of employment, and being mindful of the fact that their benefits aren't as good, that causes some division within a perceived division that in employment conditions aren't the same between tier 1 and tier 2 members, despite many of them being the same. The current employment conditions are the same, just not the retirement benefits. So all that said, I would move to make the wage adjustment at 3 1/8, 3.125.
And to accept all the other
And accept-
assumptions.
Yes, and accept all the other assumptions and recommendations.
I think to the extent that we try to make changes gradually. If inflation is running higher, we can change it next year, so maybe 3 1/8 makes sense.
Is that a second?
Yeah, same.
Okay, well, we got a motion from Woosley, second from Eswar. So now let's discuss it. Is everybody comfortable with that? Hey, hearing nothing, then we'll call for the vote. All those in favor?
Aye.
Opposed? Okay,
All right, that's the end of our pension, so you can take a break from actuarial. We do have an OPEB assumption if you wanna stick with that.
why don't we give a little potty break, 5?
Good shock treatment.
Bad guy. Amazing.
Okay. So we're gonna keep you on the tightrope,
Okay,
and we'll let you go to your OPEB.
all right. This one will be much. So, every year we have to review the OPEB assumptions. And so for the most part, we use the same assumptions as the pension plan, but there's some unique assumptions. for Each OPEB plan, but just to shift your head to the, it is mostly closed. Only the tier 1 members who didn't elect the VIVA can get the full benefits. Others can qualify for a catastrophic disability benefit, but if you look at that, that's a fraction of the cost of the other benefits. Member contributions are fixed at 8% of pay, so whatever we change here does not affect members at all. They just pay 8% of pay. The city contributions are what the board sets, except the city retains an option to cap theirs at 11% of pay. We've been right around that 11% of pay, occasionally above it. So far, the city has not exercised that cap. So this is, as with the other assumptions, it's for the 2025 valuation and the fiscal year end 2027 contributions. Just a quick update here on the projections, taking into account the investment returns. It's a good positive impact to the plan, but not a huge impact. But I do want you to notice a couple things on this chart, just to orient. First, we're just looking at police here. I have another chart coming with the fire plan. They have separate asset pools, so we track them separately. But note that the liabilities here on the left side are projected to reach a peak in about 10 years. That's because of the closed nature of the system. We're eventually going to reach that peak and those liabilities will start coming down as we're paying off retirees and there's no new actives who are retiring, or much fewer actives that are retiring. The other piece, we're only 49% funded right now, so it's a lower funded ratio. And then where the pension plan had 6.4 billion in liability, here the police is not quite up to 600 million, and you add the fire, your total liability between the two stays, I believe it stays below a billion. So it's a much smaller liability. So here, if we look at the fire, they stay below 400 million. So yes, the liabilities are much smaller, contributions are much smaller. We're talking about 13 million in contributions to the fire and 20 million to the police, so 33 million in contributions for the city compared to well over 200 million for the pension plan. So we're addressing a much smaller system. So I said this already, we use the same assumptions as the pension plan where it's applicable. There are some unique ones. The main ones are the trend rates for healthcare costs, and then all the elections for the different plans and so forth. We still have an expected return on assets that we use to set the discount rate. It's a separate discussion than the pension plan because the asset allocation is different. The trusts are different, and so it's a different number.
So here's the list of the different proposed assumptions, and as Bill mentioned, these are unique to the OPEB plan. So we're not recommending a lot of changes. There's only two. We're recommending some changes for the train rates and for the administrative expense, but nothing as far as election of the different plans go. And then we have a range, an option to change the discount rate too. So we'll go through the ones. In this presentation, we're going to go through the assumptions that we're recommending changes on. The ones where we're not recommending a change, you can find more detail in those in the appendix of the report, but we're not going to focus on those for this presentation. Also, the first part we do want to look at is the explicit subsidy. So there's two parts to the OPEB. You have the explicit subsidy and the implicit subsidy. We always focus more on the explicit subsidy because that's the part that's pre-funded by the plan. So the plan pays the minimum 100% of the lowest cost plan that's available to that's offered to the active participant. For this plan, it is the Kaiser high deductible plan. So that's when we're talking about the maximum subsidy. We're really looking at that premium, which is the lowest one. For pre-Medicare people, the maximum subsidy, that actually, we expected it to increase from 2025 to 2026 by 6.9%. The actual increase was 10.6%. And all pre-Medicare plans receive this maximum subsidy. Okay. So there was, even though there was a big increase there, the biggest impact we saw is for participants that are Medicare eligible. Because those plan premiums, we expected those to go up 5.6%, but you can see for the Kaiser plan, it went up 12.9%, but for the Anthem plans, it went up almost 35%. So that's a premium from 2025 to 2026. For the Kaiser part, that's still below the maximum subsidy, which is what's listed on the left there. But the Anthem plans, that's now above maximum subsidy that gets paid. And what that means is because it's now over that, they're no longer eligible for the reimbursements of the Medicare Part B premiums. So it is like, it's above the maximum subsidy, but it's only just above it. So, but it did creep it with that, net 35% increase. We do want to note that, that these large increases for the Medicare eligible plans, this was something in the, the industry, it was across the board for Medicare Advantage plans. It wasn't unique to the plans that are offered, through the city. So just looking at some healthcare trends, some historical. On the left, we've got pre-Medicare healthcare trends. And on the right, we've got the Medicare eligible healthcare trends. You can see on average, on the left here, we've got about 4.8%. It's been pretty much oscillating, but the last 2 years, the actual trends have been a little bit higher than, much higher than the average. And on the Medicare side, the last 4 years been higher than the average of about 3.9%. So when we're coming up with our healthcare trend rates, we typically use the, to come up with the medical trend rates, we use it's called the Getson model published. We use the most recent one published by the Society of Actuaries, in this case, the 2025. When we use that model, we do have the option to enter some initial 2 years of initial trend rates and some things like inflation. Inflation, we use what's getting used on the pension side, but we do come up with these initial short-term expectations. So for the non-Medicare eligible, we're recommending the 7.5, and for Medicare eligible, 6.5. These are slightly higher than the initial trend rates that were used last year. And part of that is building in, the main reason for that increase is the Medicaid cuts that came with the One Big Beautiful bill this year. So those are going to get phased in over about 5 years. So that's why the initial trends are slightly higher this year, but it does all trend, the ultimate trend rate in the future, that isn't changing. So it's just initially. And so we have two parts, we have the medical and the dental. The dental trend rates, we're going to keep the same. We may need to keep that at 3.5%. These graphs just show that difference. So as I mentioned, like initially, we're showing we want to have an increase in the trends, but you can see that ultimately, the ultimate trend is the same as before. So part of this is trend rates are developed on a calendar basis, but because your fiscal year isn't on calendar basis, we just want to reiterate that we take a blend of the two. So we take half of the last year and half of the prior year. So when you see sometimes when we're talking about like a calendar year rate, but then when we convert it to a fiscal year, you're going to see that slight difference, and that's because we're adjusting it for the valuation purposes. So this fiscal year beginning 2026, that's taking so we take the premiums, we know what the actual premiums are for the calendar year 2026, but then we have a projected premium for 2027. And so for fiscal year beginning 2026, we take the average of those two. So it's partly what's known and partly what's projected. So there's no questions on the trends. We'll move on to the next assumption, which is the administrative expense. So current assumption was $34 per member, and that was for fiscal year 2026, and then increasing to $35 for fiscal year ending 2027. And then that increases every year. The assumption is that it's going to increase with the wage inflation. So initially we take the actual admin expenses and we project them to the current year, and then we take the average of that. So we take the historical, projected forward, and with the wage inflation, and then we take the average of those. So the average expense assumption is coming out at for fiscal year 2025 is coming out a little over $32. When we project that forward 2 more years to get to the fiscal year 2027, it's coming out at $33. So we're recommending to lower the discount rate, to lower the assumption from that what was projected before last year from $35 per member to be $33 per member.
So, just to be clear, the experience we have of premiums going up is gonna increase costs. The trend changes are gonna increase costs. The administrative expense is a very slight reduction to costs, no way offsetting those increases. But, we haven't quantified any of that, but just trying to give you an idea of where we're headed with these things.
Quick question,
Yeah,
page 11, the chart, so I'm a little confused, maybe you covered this, but it's a one-time increase and then the model flattens it out, the increase?
For the admin expense or the?
No, the health, this is the 2025 assumption and this one.
this one, yeah, so, we look at short-term trends based on market conditions. And then what the model does is it has a methodology to grade that down over time to real per capita GDP. With the idea being that healthcare costs cannot be above real per capita GDP growth forever, or the only thing our economy would be was healthcare. So at some point it has to do that, and it's got some parameters about where you start meeting resistance to increases, which have already started happening, and blending that in. And so that's why you see it starts out with that difference. It grades down over a 5-year period to one level, and then it has a much longer grade down to the ultimate level.
And my memory serves me right, we made a similar increase last year, is that right? 6% or something, I don't. Am I wrong?
I think
I'd have to go back and.
I have to go back and look as well. I was thinking we made, one of them went up and one of them went down, but, but those adjust a lot every year, that initial, amount, based on what's happening in the market.
Any other questions?
So let me go to the expected return on assets. This is very similar to what we did for the pension plan, but it's a different asset allocation. We're still comparing Makita to this Horizon survey of investment consultants, so that you can get a sense of any differences Makita may have. On the 10-year time frame, they're both around 6.5, 6.6 is their expected return. Our current assumption is 6%. And so, we're clearly below what the current market expectations are. Here's the historical graph where the gray bar is from the 45th to 55th percentile. So ideally, we'd like to stay within the gray bar. And you can see recently, the last 3 years, we've been below the gray bar, but we're just barely below the gray bar. However, so you'll recall the pension picture doesn't look too much different than this. It's a little bit different, but not too much. And we were very much arguing that you should just keep the assumption where it is. Here, we're actually suggesting you could consider an increase to 6.25. And so we put the arguments for both. So there are two ways to think about this. And so I'll talk about why I look at this a little differently than the pension, and I'm putting the range out there. The arguments for keeping it at 6 are essentially the same as on the pension. Except the one thing I would add here is that this plan is only 49% funded. So there's a little bit more bias to being conservative if you're only 49% funded, from my perspective. What's different and causes me to think you should consider increasing to 6 1/4 is the same sort of arguments would apply to the pension in terms of 6 1/4 still below the expected return on a 10-year horizon, and the capital market assumptions have been out for 3 years. We're not sure where they're going in the future. But what's different is the OPEB plan is much smaller, much smaller. So if you have to reverse course and increase, the impact is not as much. And member contributions are not affected. So if we reduce the contribution, increase it, it's just a dollar amount the city has to contribute. And it's on that, what was it, 23 plus 13, about 36 million is the contribution that you're adjusting up or down. The other piece that makes me look at the OPEB plan a little differently is it's closed. So, and this would be a much bigger impact if you were closer to 100% funded, but there's very little use for getting assets above 100% because there aren't the increasing benefits from new members that you could use those to fund. You can use them to reduce some risk, which is harder to do with OPEB because the liabilities move around. But it causes me to just take a little different perspective than I would on the pension plan. And so I think you could consider a change to 6 1/4. I would not go to 6 1/2, which is where the median is. So you're still having some conservatism, or you could keep it at 6.
Bill, would it be safe to say that with the plan being closed and the member contributions capped, that at some point, barring some miraculous investing, the city's just gonna be pay as you go in this plan?
So ultimately, with a closed plan, I think your goal is to become pay as you go, but just not too soon.
Yes.
You want to become pay as you go when the remaining benefit payments are low. But I think if we go back up here, we project right now that the city will pay these rates for like another
20 years.
25 years, and then it goes away. So we do have a plan that would get it to 100% funded with just the expected returns in that time period. If we stay the course, I do think, you know, the funding policy for it is something, probably not while I'm still the actuary, but maybe in 10 years or 15 years, you may want to revisit exactly how we're doing this because of the potential for overshooting. And you just want to make sure that you don't have too large of an unfunded liability, but you also don't want to develop a huge surplus.
Bill, am I correct in sort of thinking about these two options as, again, since this is a closed plan and it's underfunded, 6% has the city paying more now, 6.5% has the potential for the city to pay more later.
Yeah, 6 1/4.
Or 6 1/4, sorry, 6 1/4.
Yeah, so they pay slightly less now.
Now.
If it didn't work out, they'd have to pay later.
Okay, so it's right pocket to left pocket in some ways.
It's just how you wanna, because we're not talking about changing the investment strategy here.
Yeah,
We're,
it's,
we're talking about how quickly you want to, fund the plan.
and when fund, and the timing of when the funding potentially happens.
Right.
I mean, it seems to me that we're at 49% funded. It may not be the right time. It's better to be more conservative at 6% rather than 6.25%, right? And that'd be my thought to them.
Yeah, that is one of the primary arguments for staying at 6, I think, is that you're 49% funded.
But to be,
Go ahead, Sunita.
how, what is the impact of this drastic increase in the premium assumption? Because, you're doing it in a year where you're increasing the unfunded liability, and so is this the left pocket, right pocket is more that, or?
So just to reiterate, that huge increase from 2025 to 2026, that's not an assumption change, that's based on the actual. So the assumption is how much more is it gonna increase in the future. So because this year you saw a much larger increase than before, you'll see a loss for that. But that large increase, that'll be like recognized now and then amortized. The actual assumption, the trend rate for 2027 going onwards, you have that increase, but it's not as big of an impact as that huge increase that we saw, the actual from 2025 to 2026.
Yeah.
Does that?
Yeah, that does help, so, but approximately, what's the, sort of the dollar number?
I don't think we've calculated
okay,
the
yeah,
dollar, we just,
Value that, yes.
Okay, thanks.
there,
So one other, I guess maybe you can weigh in on where I'm sort of stuck on this. To Espoir's point, we are 49% funded, which was the reason for staying at 6%. But I guess that to me feels to weigh very evenly against the fact that the surplus assets have very limited use, which makes me think, we want to be very careful here. We don't want to suddenly get to 110% funded accidentally. So any guidance on how to balance these competing interests?
well, I think you're thinking about it the same way I am, which is why I put the options out there is, yes, 49% funded would make me lean. If you were 80% funded, I'd be saying 6.25, maybe 6.5. And maybe we should talk about your investment policy. Sort of thing, but at 49% funded, to me, it's a close call, which you want to do, because even going to 6.25, we have a funding plan that's still gonna get you to 100% based on that 6.25 estimate. In the same time period. So it's, but as you pointed out, if you don't earn that, it just means you're gonna have to contribute it later versus now. So to me, this is a close call, and I can argue either way, which I tried to do on that one slide, but.
And you can also see that, even though you're projected to get to that 100%, and 6%, it's still like 20 years in the future. So, even if, so I don't think you would necessarily like accidentally get to it. We would have a lot of good warning for it. I mean, obviously, this year everyone's seeing great returns, on the assets. If you were to have that, sure, that 100% is going to get shifted, maybe forward, maybe a year or two. There are going to be years where you have a down market. So I don't think it's necessarily going to shift it, and I don't think that 100% funding is going to sneak up.
Yeah.
I mean,
and there's volatility around that number.
Yeah.
based on your argument, Bill.
Which one?
My conclusion is I'm comfortable with 6%. I mean, we're so far away from, surplus. I mean, bring that up, it's kind of like it's a mile or 10 miles away. I don't think that weighs heavily on my decision making. 6% is my thought.
And I guess another consideration for me is what's the probability you don't hit the number, right? And we've gone through 5 years of, kind of superior market returns. So why increase our expectations at this point? Maybe wait for a point when expectations are low and markets come down, right? So I would say stay the course at 6%.
Would it be fair to say moving to 6.25, provide the city would pay less in the short term, as long as it stays at that way, right? So that could provide the city some relief in what we know is economic not greatness for the city right now. The risk being in the future, the city might have to pay more later, as you put it. But the benefit being perhaps in some future years, the city's better economically, and those savings now could help on the city side. And if we move from 6 to 6.25, there's no change to the member contribution rate.
Correct.
So it's all savings for the city in the short term, when the city can probably use it right now. So I personally kind of am leaning towards 6.25 for that reason. If it's a safe target already and it provides relief for the city, that frees up funding for the city to use for other purposes. And if we're gonna get to 100 anyway on the plan at 6.25, that's kind of where I'm sitting. So.
Bill, I had a question for you, and obviously I'm not looking for exact numbers, but maybe more so trends. In the last few years, as people retired, we know that they're taking their checks, but they're not necessarily taking medical. A few years back, we negotiated for an in-loop plan that is much, much cheaper than if the city was actually paying for medical. And I think as we were talking about earlier, our medical typically only applies to a small area in the Bay Area. So they could move in the outskirts of the city, let alone into a different state, and may even potentially not be taking anything then in lieu. So I guess my question is the trend showing us going lower in people using medical, staying the same, or going higher?
So, so the in-lieu program has not been around a long time. But here's our data on the people electing in lieu. So about 30% of people who retire from active status are going in lieu. And about 50% of the vested terminated members who are still eligible, which is a pretty small group, are going in. What we have not seen, because it hasn't been around very long, but it's a big question, is whether anyone is able to actually use their in lieu benefits. So we're still holding the liability for the in lieu credit. So when they choose in lieu, they don't get the medical coverage, but they get a credit they can use towards future medical coverage. And that credit is 25% of what they would have got if they used it.
And just to clarify, but only within the city medical plans. It's not like Aviva or anything else. It
No,
has to be a
right.
city medical plan. Okay, I'm just trying to remember when we negotiated this.
Correct. That's my recollection. One thought, we're just waiting to see some data, but one thought what I've had is once they start in lieu, there aren't that many years before they hit Medicare eligibility. And once they hit Medicare eligibility, it's been hard to actually use the in lieu credit because the plan credit covers most of the benefit.
In which case that in lieu will fall back as a credit to the city.
Yes.
To
To the city or to the?
Well, to the plan.
To the plan.
It will leave city
Well, we
contribution.
leave city contributions if we start wiping it off the books.
Yes.
We have not wiped any of it off the books yet.
And that's kind of the unknown right now. So I understand what everybody's saying, but I'm always sensitive secondary to the plan sponsor's ability to pay. And we do know that they're having some budget deficits, and I think there's some unknown that's gonna come from this in lieu, because it is fairly new. I'm in it, I know. And I'm not sure that I'll ever really take much out of it. Which will roll back, and I've seen a lot of people move out of area who are going into lieu and getting medical. You know, a good friend of ours that went to Florida, and he's like, I can get cheaper on the market in Florida than I can through San Jose's PPO. So he's taken in lieu, which is saving the city 75% of what their contribution would be. So I think it's something that we could change. I would almost be tempted to agree with Dave at was it 6 1/4? Because I think there's just a lot of unknown, and it gives the city a little relief right now.
Can we ask Councilman Casey to weigh in?
I'm welcome to. I'm all for this. If the guy sitting next to him says we can't listen to him. But you know, you could go to take a bathroom break or something.
Do the members of the public get to weigh in at some point?
Yes, they do. He's the liaison.
I would love the 6 1/4, obviously, for obvious reasons, but, you know, it's an internal conversation, but for the rationale you both used, I know the city would appreciate the 6 1/4.
What's the dollar amount we're talking about? I guess we still don't have next month.
We don't have that. We will have preliminary numbers next.
I'm sorry, does that in lieu, because it remains as a credit, the dollars stay in the plan and therefore the dollars still work for the plan?
Yes.
So we could postpone a decision on that till the next meeting. I would like you to adopt the other assumptions, but then if we could come in with our preliminary results at both 6 and 6 1/4, and so you'd be able to see the
dollar amount
and the impact of the cost changes for the cost increases for this year. And just see the whole picture before you make a final decision.
I'm very supportive of that.
Just to make one other comment, I know we discussed earlier this year that the Medicare Advantage rates have gone up, and for the first time, at least on the Anthem side, our membership are going to be paying for these programs. You know, so now this is for those who have the in lieu credits, this is another place where they can now use that money. I don't know how we factor that in to see how, because that has been, once they crossed over 65, they then no longer have the opportunity to use it. But as those benefits continue their.
So anyone in Anthem might potentially be able to use those credits in Anthem, although it may not help anyone in Kaiser.
Right.
Not yet.
Not yet. I'm good with that. I don't normally make a motion, but I will motion that we accept all the other assumptions, but we hold off on the 6 and 6 1/4 until we can see the actual dollar numbers.
I'll second that.
So we got a motion by Votto, second by Gretchen. Any further discussion? All those in favor?
Aye.
Opposed? Okay,
Thank
Thank
you
you,
very
Bill.
much.
Sorry to make more work for you for next month.
Don't worry, it's one assumption, that's why I wanted the answer on the other ones.
Okay, this will take us moving back to 4A, oral update from our CEO.
Usually I say good morning. Oh, it's still morning. Okay. Last month I attended the NC PERS accredited fiduciary program. They have a 4-module program that you take in 2 module increments. It's for trustees. It's primarily focused for trustees, but also for administrators that attend from around the country.
The program explored what it means to be a fiduciary and how it looks in a well-functioning board. I hope to complete the rest of the program in the coming year. Because it's right after, I attended their NCPERS Fall Conference, which featured various current pension fund topics, including investments, actuarial trends, and detailed sessions such as death match processing. From a staffing perspective, our benefits department is currently recruiting for 3 positions, all within our pension group of the benefits division. With these 3 positions, and a maternity leave, this represents a 50% staffing level reduction across that pension working group, with our busiest months of the year about to start with open enrollment. So I thought it was worth mentioning, and I also wanted to address what we've done to address this staffing concern as best we can. First, we've expedited analyst hiring process from an existing analyst list, but unfortunately, it did not result in a hiring. This now requires that we post a new hiring request. We hired a new retiree rehire, Donna Heff. Welcome back, Donna. Donna was a recently retired specialist that worked in our organization. She's now back on a part-time basis. We extended an existing temporary staff specialist, and we also hired a new analyst in a temporary position to support RRS through the duration of that maternity leave. We've shifted more work to our existing retiree rehires, and prior to open enrollment, the health team helped out where they could, but with open enrollment in full swing, that support has ended. We're bridging the workload gaps with some additional overtime, but unfortunately, we have to prioritize the critical and time-sensitive work, creating a little some backlogs within the unit. On a much better note, our deputy CIO classification was approved at City Council earlier this week. Now that is complete, I will be working with the mayor's office to request an overstrength position as discussed at one of our previous meetings. Our investment compensation study is in full progress right now. We signed the service order with Gallagher a week or so ago. At this point, we expect the process will take 12 to 14 weeks. As I mentioned, ORS open enrollment activities have started leading up to so as a reminder, open enrollment began Saturday, November 1st and runs through November 30th. Open enrollment information packets were mailed to retirees last month. ORS staff conducted open enrollment presentations at the POA and SJREA at their regular meetings in October. Yesterday, we had a retiree health fair that was held at Leninger Center. We had over 200 attendees, and staff were on hand to answer questions and deliver personalized service to our retirees. Currently, ORS has already received 426 forms for processing since November 1st. Procurement contract update, we're working with Milligan. We have an agreement with Milliman on the last draft of our contract, and we're pushing that contract through the San Jose contracting system. So that's basically done. Compensation consultant service order was signed and finalized, and that work has begun. And then lastly, our internal audit service procurement, our internal audit service procurement has been completed. We have had back and forth with Baker Tilly on revisions to our proposed contract. And right now we're discussing those revisions with Reed Smith and the risk department. And then lastly, on the agenda today, it was the service order that was signed that was finalized last week using the city's master services agreement to hire our executive search consultant, Alliance. Our Suite 560 build out is
nearing completion. All the furniture has been installed and we're waiting for electrical and internet hookups to be completed so that the inspections can be scheduled for later this month. Our expectation is that the space will be ready for staff to move in before the end of the month. Updates on our climate survey. I met with senior staff on Tuesday, October 14th, and all staff during a quarterly all-staff meeting on November 4th. We discussed the positive results of the climate survey and focused on the areas of improvement. The plan is to work with staff to hear more details in some of the highlighted areas, possibly through some lunch and learn sessions, which will be scheduled throughout the year, the remainder of the year. That's all I have. With that, I'll take questions.
Go ahead, Dick.
Yeah, thanks, John. Maybe when the magazine comes out here soon, we can put the actual cost, the Anthem cost, the Medicare, and the different numbers that we're taking today, Kaiser and other things that are gonna be increased. Just because percentages is one thing, but to put actual, gonna cost you $5 or $10.
Sure.
Thank you.
I do know we send out communications to the membership, but I'll review that to make sure. Maybe we can put a summary in our next.
I just got the latest and it's very good. Appreciate it.
Any other questions or comments for John? Okay, thank you.
Thank you.
Councilmember Casey.
No substantive update.
Thank you, sir. Okay. We'll move on to 4F, nomination for the position of board chair for calendar year 2026. We'll entertain motions.
If you'll allow me just to read a few excerpts from the policy, just to refresh everybody. So for the nomination process, at the November regular meeting of the board shall seek nominations for the positions of board chair and board vice chair. Nominees must be nominated by another voting member of the board. Nominees may accept or decline the nomination. And then I feel like there's a couple of things that I think that are worthwhile mentioning around term limits and whatnot. The term of the board chair and vice chair position shall be for 1 year. The standing term limit shall be 2 consecutive terms. No individual may occupy the same position, board chair or board vice chair, for more than 2 consecutive terms without the affirming vote of 7 voting board members. The board chair and vice chair shall be from different groups of the board members. One group is comprised of those who are participants in the plan, and the other group comprised of those who are not participants in the plan. Notwithstanding paragraph 10, which is the one that I just read, if after a good faith effort to identify nominees from the requisite group, no board member from the requisite group is willing and able to run as the board chair or vice chair, the board may elect an individual from the other group. Any questions about that before we?
Clarification there.
Sure.
So, cause I thought there was a change that whether it be the uniform or non-uniform, it makes no difference now. We can just nominate anybody we like.
So, I think previously the chair had to switch from uniform to non-uniform. That's not the case. But once a chair is selected, the vice chair needs to be from the other group.
Without a supermajority.
Gotcha.
Correct. Okay.
Yeah. So I will open it up for nomination.
Mr. Chair.
I will open it up for nominations.
Yeah, Mr. Chair, you will accept, I nominate you for chair.
Okay, well, I appreciate that. I would like to hear from other people as if there's anyone else who might make a nomination.
I guess my question would be, I thought, when you compare 2 years, 2 consecutive years?
Yes. So, and again, with a supermajority, I could in theory do another year, but I am also a firm believer in moving things around. I had very specific reasons. As to why I wanted to stay on, obviously onboarding with y'all and getting our meetings moved. So I've accomplished what I needed to accomplish. I am more than willing to continue to do it, but I would like to know if there's other people interested and see if there's any other nominations.
I would nominate Andrew. There was no smile that came to his face.
I would accept the nomination.
I would second.
I don't believe we have to second it. That's next meeting. It's just nominations.
So if there are no other nominations, the only question would be if you accept.
I appreciate it, Dick, but I will decline it. I think you're in good hands with Andrew.
Thank you.
Okay, no other nominations. We'll move on to vice chair. I'll open up for nominations to vice chair. And as John had stated, ideally, without a supermajority, it would be a member of the public, not the plan.
I know this person has some time restraints last time we asked, but I'm gonna ask again to see if it's anything's changed, but Eshwar, would you be willing to accept the nomination?
Thank you, Andrew, I would.
Okay, do we have any other nominations? All right, I believe our nominations are closed. Moving on. Next month, we will make those votes. Okay, we will move on to retirements. Paul G. Hamble, Police Lieutenant, Police Department, effective November 29th, 2025, with 26.05 years of service. Don C. Ho, Fire Captain, Fire Department, effective October 25th, 2025, with 25.39 years of service. Huang Sun, Fire Captain, Fire Department, effective November 6th, 2025, with 25.25 years of service. Raymond Vaughn, Police Sergeant, Police Department, effective December 3rd, 2025, with 26.06 years of service. I'll entertain a motion.
So moved.
I have a motion from Dick.
Second.
I have a second from Woosley. All those in favor?
Aye.
Opposed? Any words?
Yeah, real quick, I'm the older guy, this is the first time I don't know anybody.
Yeah, good luck to everybody in retirement and thank you for your service to fine people of San Jose.
Yeah, congratulations to those fire captains that are retiring. They're great individuals. Thank you for your service. Enjoy your retirement.
Okay, we have deferred vested. David W. Hartman, Police Officer, Police Department, effective November 29th, 2025, with 12.36 years of service. James A. William II, Assistant Fire Chief, Fire Department, effective October 28th, 2025, 9.84 years of service with reciprocity. I'll entertain a motion.
So moved.
I have a motion from Dick,
Second.
second from Woosley. All those in favor?
Aye.
All right. Okay, we'll move on to 6, death and survivorship notification. Notification of the death of John Baricamo, Police Sergeant, retired December 4th, 1985, died August 28th, 2025. Survivorship benefits to Carol Baricamo, spouse. Notification of the death of Paul Eden, Fire Captain, retired December 12th, 2010, died September 24th, 2025. Survivorship benefits to Deborah Eden, spouse. Notification of the death of John Fiedel, Deputy Fire Chief, retired January 7th, 1993, died September 24th, 2025. No survivorship benefits. Notification of the death of Michael Hennessy, Fire Captain, retired March 17, 1994, died September 16th, 2025. Survivorship benefits to Nellie Hennessy, spouse. I'll have a moment of silence. Okay, any words?
Yes, Mr. Chairman, I had the privilege to work with all of them, a couple of them really close, and then a couple that were too young, but appreciate their service and the best of their families.
And I'd echo those sentiments for the police sergeant as well. Almost 40 years of retirement, that's pretty good.
Yeah, I will say, and I'm not 100%, but I do have a friend, whose name is Brickamo. Dad was a police officer, and if I'm assuming this is the same guy, he was a hell of a father because his son's a hell of a guy. So condolences to his family. All right, committee reports. 7-1 Investment Committee.
We've not had a meeting.
Okay, 7-2 Audit Risk.
Mr. Chair, we had a meeting last week. It was a very full meeting.
Yes, it looks like it.
And you can tell by the number of attachments and decisions to make and so forth. We had a discussion and a meeting with NGO, our external auditor, reviewed their report as well as the letter. We also had the ACFR review that Benji and the team had worked very hard on, as well as the dealing with the results and I guess closings of the city auditor recommendations, as well as the internal audit recommendations, which are holdover from more than a year and a half ago. And we have some good news coming from that. And then finally, we have some discussion on the financial audit. One particular topic that John will talk about later with respect to unfunded commitments. Cybersecurity penetration testing, we looked at the results, and finally, we had an update on the internal audit services contract.
So it looks like we need to do receive and file, and we also have some discussion and action.
Yeah.
John, you want to take that, please?
Sure. So the agenda today shows a discussion action regarding the Board of Administration for the Police and Fire. This says Federated, but your motion should not include Federated. From NGO and the plan sponsors audit to accept the independent auditor's report for internal controls over financial reporting, compliance, and other matters based on the audit of financial statements performed. And then second, accept the independent auditor's management letters, comments, and recommendation regarding audit findings. So they don't typically do a presentation at the boards.
It's an accept, right?
Sort yes, it's a yes. You need we need a motion to accept each of these.
Okay. Okay, well, how many different ones we have to accept?
There's two. So one is the
okay
auditor report.
A.1 and A.
Correct.
2. Okay. So I have a motion from Dick.
Second.
I have a second from Gretchen. All those in favor?
Aye.
Opposed? And the second one being in discussion and action on the approved. Says employee system, federated system, police and fire retirement plans, annual comprehensive financial report. We are only doing that for us and not federated.
Right, so this would be the approval of the police and fire department's retirement plans, annual comprehensive financial report for the fiscal year 24-25. I'll kick it over to Benji in a minute, but Benji and her team, you know, they work months of work leading up to this moment to develop this report. Not only is it accurate, but it's also beautiful, and they take a lot of pride in it. So, you know, with that, I'll hand it over to Benji.
So there wasn't really much of a change for this year's ACFR, but you will notice that on the financial statements, note 2, there are mentions of restatement due to GASB 101. There's been a change in accounting principle, so we've had to we restated some of the beginning balances to account for the GASB 101, which is compensated absences. Some of the sick leave balances in the past were not being accrued, but due to GASB 101, if it's more likely than not somebody is going to be paid out for it, then we need to accrue it as a liability as well. So that's what all the changes that happen that you'll see on the financial statements on note 2, and then some of the required supplemental information in the OSI, will show.
Okay, I'll entertain the acceptance and approval of this. So moved. Added from Dick.
Second.
Second Ashbar. All those in favor?
Aye.
Opposed? There is one more discussion and action.
Yes.
On the outstanding internal audit recommendation.
So, as we had done, probably 2 meetings ago, at the at the audit committee, we presented a set of internal audit items that had been completed by staff and reviewed by me, and designated as proposed to be closed. In the vacuum of having an internal audit, we're bringing those to the audit committees and then the boards for review and approval. And so on your agenda, you see the list of, I believe it's 8 items in proposed complete, bringing us to 17 outstanding items at this point. So also on the agenda is the updated dashboard showing you the progress that we've made. So we're looking for approval today to designate these 8 items as that are proposed close to be complete.
Motion to approve. And a motion from Dick,
Second.
second from Gretchen. All those in favor?
Aye.
Opposed?
I just wanted to say one thing though. I think this is quite momentous that, if I may, Chair. That we have all these issues resolved and we acknowledge that we are in committee, that, we're really turning a chapter in the face.
Thank you.
Thank you. Okay. Now we have another one here. Discussion and action regarding communication to the Board of Administration of the City of San Jose Police and Fire Retirement. No. Just. Oh, okay. Okay, never mind.
Well, where's 7.3?
Okay, governance.
Notice we're having a meeting to extend the board.
Okay. Minutes. Disability.
We'll have the meeting Monday, which is the 10th at 10 o'clock here. We have 2 applicants.
Okay. And 7.5, joint personnel.
So, I'll let John talk maybe, but we started the process of the CIO hire, that's a highlight, so.
So we've had, the JPCI meeting, I think it was the 24th. At that meeting, we had our first discussion with Alliance Resource Consulting, who is our executive recruiter. The committee worked with the recruiter to help give input to define the characteristics of our next CIO that was then used to draft the candidate profile. I want to get ahead of Andrew.
Go ahead.
Are you sure?
Yeah,
Okay,
that's
so
good. You're on a roll.
Since that meeting, the ad hoc, the joint personnel ad hoc committee has worked with me and the recruiter to finalize the development of that profile. And as of effective late yesterday, that candidate profile went live. So after this board meeting, I'll be sending an email to both boards, just sharing the link to this candidate profile and the overall schedule that we're anticipating. You want me to go through the schedule? Okay. Candidate, the JPC, we're targeting to meet on December 12th to have the recruiter present the candidates. And at that meeting, the goal is to make a candidate selection for first round interviews. First round interviews with the JPC, we're targeting the week of January 5th. We're also anticipating a second round of interviews with the JPC, targeting the week of January 26th. So at the end of January, at the end of the January 26th, the meeting that we have the week of January 26th, we're hoping to have a final list of candidates to be sent to a joint board meeting. that joint board meeting, we're looking for the week of February 9th. So, start looking at your calendars. I didn't live on this side of the process last time. But I'm told that getting the joint boards together, is, interesting challenge. And so we're gonna start, Cynthia and we discussed it this morning. We're gonna start reaching out to try to identify a date where we can get the biggest majority, during, as close to we can around those weeks.
You know, it's a holiday, you don't get nobody.
Exactly. That's it.
Yeah, the only thing I'll add is, like you might have said and I missed it, the application that's live right now, it's, closes on December 5th.
And a lot of discussion and actions on here, dude.
Those are all just for oral updates.
Okay, oral updates, alright.
Just receive and file.
Yep, receive and file the minutes. And we have 7-6 Joint Personnel Ad Hoc Committee.
John discovered everything, nothing to add.
Okay, any proposed agenda items? Any comments from the public? Hearing none, we're adjourned.